Welcome to the Commodity Brief Podcast, your weekly intelligence on alternative assets and commodities. I'm your host, and today we're diving into these topics. Let's get into it.
So if you log on to Kalshi right now, which for anyone unfamiliar is one of the premier platforms for prediction markets, you're going to see a statistic that just completely shatters how we usually think about global trade.
Oh, absolutely. It's a staggering number.
Right. Because as of this morning, traders are pricing in only a 44% chance that commercial traffic through the Strait of Hormuz will return to normal before December 2026.
Which is, that's less than a coin flip.
Exactly. Less than a coin flip. And, for decades, when we looked at major global disruptions like a war or a blocked trade route, some kind of supply chain collapse, we always understood the impact through the rearview mirror.
Yeah, you'd wait a month for some prominent think tank to publish a really dense white paper.
Right. Or you'd wait for the quarterly GDP numbers to finally drop. And eventually, someone in a suit would point to a line graph on CNBC and say, there it is. That's where the pain hit.
But we always analyzed the crises after the dust had already settled.
Exactly. But this 44% probability on Kalshi, it's something entirely different. We are watching thousands of people put their own capital on the line to give real-time quantified odds on a geopolitical choke point.
And that shift from historical analysis to real-time risk pricing is just profound.
It really is. Because it changes the whole dynamic, right?
Yeah. The traditional method of waiting for the quarterly report is comforting because, the uncertainty has been resolved. But it's fundamentally delayed.
Too late to actually do anything about it.
Right. By the time that white paper is published, the global economy has already absorbed the shock. The opportunity to hedge against it is completely gone.
So what we're seeing with this specific metric on the Strait of Hormuz is essentially the compression of time.
Exactly. The gap between a physical event happening in the Middle East and that event being priced into the financial architecture of the world has basically collapsed to zero.
It's like a breathing, moving consensus of global anxiety, just updated every single millisecond.
Which is a perfect way to put it.
And that compression of time, that brings us directly to the central thesis of our deep dive today. We've gathered this massive stack of source material for this conversation.
A really diverse stack, too.
Yeah, we have a comprehensive commodity brief mapping out the whole macroeconomic landscape. We have a major platform announcement from Kalshi detailing their new commodities hub.
Plus that in-depth geopolitical market analysis from the IB Times covering the timeline of the Strait of Hormuz.
Right, and finally we have this really rigorous and frankly terrifying investment report from Greenwald News on the emerging reality of global water rights.
When you take all of those seemingly disparate sources and lay them out on the table, one glaring theme emerges.
Scarcity. Scarcity is the defining commodity market signal of 2026.
It really is the unifying theory of the current global economy. For the better part of the late 20th and early 21st centuries, financial markets just operated on this baseline assumption of infinite elasticity.
Right, like if we needed more oil, we just drilled more.
Exactly. If we needed more copper, we opened a new mine. Supply chains were just viewed as these frictionless conveyor belts.
But what all of these sources are telling us is that the era of perceived infinity is over.
We are abruptly crashing into the hard physical limits of the Earth.
Yeah. Whether it's millions of barrels of crude oil choking through a blocked, war-torn strait, or fresh water literally vanishing from a depleting aquifer, or, intraday price signals that disappear in 15 minutes.
Scarcity is being priced faster and with just brutal precision like never before.
So our mission today is to equip you, the listener, with the mechanics to understand and navigate this really fast-moving environment. We want to decode these signals so you aren't the person reading the delayed think tank report when the market has already moved on.
Because by then, you've missed the boat.
Exactly. Now, before we dive into the deep end, I do want to make a quick but really critical note regarding the nature of the sources we're analyzing today.
Yeah, this is important to lay out.
This deep dive touches on some highly sensitive, actively unfolding geopolitical events. Specifically, the IB Times analysis requires us to discuss the ongoing conflict involving the U.S., Iran, allied nations, and regional proxies.
Which obviously includes the military strikes and the resulting policy decisions.
Right. But our goal today is purely analytical and structural. We're looking exclusively at how these physical events are impacting global markets and supply chain mechanics, based strictly on the text provided.
We are totally impartial observers here.
Exactly. We are not endorsing any political viewpoints. We aren't assigning moral or political blame to anyone. We're just treating these geopolitical events as inputs into a complex economic machine.
Because that is exactly how the commodity markets view them. The markets are entirely unsentimental.
They really are. They don't care about political ideology.
Not at all. They only care about supply, demand, and the risk of disruption. So to understand the financial tools being built in 2026, we have to look through that same fiercely objective lens.
Okay, so let's start applying that objective lens to the waters of the Middle East. Because the timeline provided by the IB Times article reads like a psychological thriller, tracking the collective denial of the global market.
It really does. It's fascinating to watch the sentiment shift.
The piece uses Kalshi's specific definition of normal traffic through the Strait of Hormuz. They define it as a 7-day moving average of more than 60 transit calls, based on data from IMF PortWatch.
So it's a highly specific, very measurable threshold.
Right. And when the conflict in the region first escalated to the point of disrupting those shipping lanes, the market's initial reaction was just incredibly dismissive. They treated it like a blip.
Which, to be fair, is standard operating procedure for global markets facing a geopolitical shock.
You think? Why is that the default?
Well, the muscle memory of the modern trader is always a reversion to the mean. Over the past 40 years, almost every major disruption in a critical shipping lane eventually ended with some diplomatic intervention or a military escort operation.
Or a ceasefire that just restored the status quo.
Exactly. The market assumes the cost of prolonged disruption is so unacceptably high for the global economy that the major powers will simply force a resolution.
And you can see that ingrained optimism playing out perfectly in the early data. Let's trace the shifting goalposts here.
Let's do it.
So, in March of this year, Kalshi contracts were pricing a highly optimistic 76% probability that traffic would normalize by July 1st.
So 3 out of 4 traders looked at the missile strikes, looked at the rerouted tankers, and effectively said, this is noise, it'll be over by summer.
Right. They were modeling the disruption as an isolated, discrete event.
They just assumed some behind-the-scenes diplomatic off-ramp was already being negotiated, and that the risk premium would wash out of the market within a quarter.
But the off-ramp never materialized.
Yeah.
By April, the odds for that July 1st normalization dropped to 59%.
So the confidence is starting to fracture there, but it's still the favored outcome.
Yeah, barely. But then we move into May, and the market realizes summer is out of the question. They push the goalposts back. They open contracts for September 1st.
But even for that delayed date, the odds drop to 54%.
Right. You are basically watching the slow, painful death of the temporary shock narrative.
Month by month, the reality on the ground is just forcing the market to bleed out its optimism.
And it gets much darker. June hits, and the floor just falls out.
Yeah.
In June, Kalshi contracts were pricing a 66% chance that traffic wouldn't normalize before 2027.
We went from resolved by summer to maybe next year if we're lucky.
And that brings us to July, which gave us the sobering statistic we opened the show with, only a 44% probability of normal traffic resuming by December 1st of this year.
It's a massive capitulation, and January 2027 is the very first contract date where normalization is priced as more likely than not, and even then, it's sitting at a really weak 53%.
Okay, here is where I want to push back on the underlying premise of these platforms, though.
Sure, go ahead.
Prediction markets are constantly hailed as the ultimate wisdom of the crowds, right? The theory is that if you aggregate the knowledge, the insider whispers, the models of thousands of financially motivated actors, you get this hyper-accurate forecast.
That's the theory, yes.
Yet this supposedly hyper-efficient market got this consistently disastrously wrong for 5 solid months. They constantly underestimated the duration of the disruption.
They did. They completely whiffed on the timeline.
So does this mean there's a fundamental flaw in how prediction markets operate? Or did the underlying nature of the conflict transform in a way that just broke their historical models?
The IB Times analysis strongly points to the latter. I mean, the market wasn't acting irrationally. It was executing perfectly on an outdated paradigm.
So they were solving the wrong equation.
Exactly. As we discussed, the historical model for a Middle Eastern shipping disruption is a localized spike in tension, followed by a heavily mediated de-escalation. The market was trying to price an event with a clear beginning, middle, and end.
But that's not what this is.
No, not at all. What traders are collectively realizing, which is reflected in that agonizing month-by-month drop in probability, is that this cycle of tit-for-tat strikes might not be a discrete event at all.
The involvement of the U.S., its allies, Iran, and all these highly decentralized proxy groups utilizing cheap, precision-guided munitions. It's a completely new dynamic.
Yeah, the market is slowly waking up to the fact that this instability might be a permanent, structural feature of the region. They are waking up to a true new normal.
Calling a conflict that chokes off a massive percentage of the world's daily oil supply a permanent structural feature is just a terrifying concept.
It forces a total rewiring of the global macroeconomic engine.
Right, because think about the difference in behavior. If you're a national government and you believe a choke point is temporarily blocked, your strategy is just patience.
You draw down your strategic petroleum reserves, you delay non-essential shipments, you ride out the storm.
But if you come to the realization that the choke point is permanently unstable, caught in this perpetual crossfire, patience is no longer a viable strategy.
You have to adapt to a world where that specific geographic vulnerability is a constant threat.
So let's trace the domino effect of that realization, because the sources lay out a very clear, highly consequential chain reaction that eventually lands right on the listener's kitchen table.
The first domino is the immediate, logical response. Seek a workaround.
Right. If you can't sail the oil through the strait, you put it in a pipe and pump it over the land. Infrastructure substitution.
It's the obvious geographical play. Governments try to accelerate overland pipelines to bypass the maritime choke point.
But the IB Times piece throws cold water on that strategy almost immediately. It explicitly details why these terrestrial workarounds are fundamentally inadequate in the modern era of warfare.
Because they're just as vulnerable now.
Exactly. The article highlights the two prime bypass routes: Saudi Arabia's East-West pipeline and the UAE's Habshan-Fujairah pipeline, which completely bypasses the Strait of Hormuz.
And both of those massive critical pieces of alternative infrastructure were directly targeted and attacked in April and May of 2026.
This is the brutal reality of asymmetrical warfare.
Historically, a naval choke point was a uniquely vulnerable location because ships are slow and, highly concentrated. But modern conflict, specifically cheap drone technology, does not respect neat geographic distinctions between land and sea.
Right. If the goal is to inflict economic pain by disrupting global energy flows, they aren't going to limit operations to the water if the oil has just been shifted to a static steel pipe on land.
The workarounds fail to provide absolute security because the threat vector has expanded geographically.
Okay, so if the water is blocked,
Yeah.
the land routes are actively under fire, we hit the second domino, the geopolitical risk premium.
A term analysts love to throw around on CNBC.
But its actual mechanics are incredibly tangible, right?
Oh, absolutely. The best way to understand the geopolitical risk premium is to view it as a permanent tax on structural anxiety.
A tax on anxiety, I like that.
If the primary arteries of global energy transport are perpetually unstable, that instability has a mathematical cost. It means that even on a completely quiet Tuesday, when no tankers are harassed, the global price of oil remains artificially elevated.
Because shippers and insurers are forced to price in the mathematical possibility of an attack occurring tomorrow.
Exactly.
I was trying to think of an analogy for this, and it feels exactly like trying to buy a house in a severe hurricane zone.
Oh, that's a good one.
Right. Because even in the middle of a beautiful, calm spring day, your monthly home insurance premium is astronomical. The insurance company isn't charging you for the weather today. They're charging you because the structural risk of a hurricane is baked into the geography.
In this case, the global energy market is permanently living in the hurricane zone.
The premium establishes a permanently elevated floor for the price of energy. The baseline cost of moving molecules around the planet has fundamentally shifted upward.
And when that energy floor shifts upward, it triggers the third and really most destructive domino, the inflation trap.
This is where geopolitical abstraction becomes highly personal for anyone listening. If energy is structurally more expensive, literally everything else becomes more expensive.
Because energy is the master input. It is the fundamental ingredient of the entire physical economy. You cannot decouple it from daily life.
Manufacturing requires industrial power. Commercial agriculture requires diesel for tractors and natural gas for petroleum-based fertilizers.
Global supply chains rely on bunker fuel for cargo ships. Every single product that is harvested, mined, manufactured, or transported relies on that underlying energy cost.
So bringing it down to the micro level, the cost of a basic loaf of bread at your local grocery store goes up. Not because people are hoarding bread, but because the diesel fuel required for the combine harvester in Kansas costs more.
And the electricity to run the industrial ovens at the bakery costs more. and the fuel for the delivery trucks costs more.
It's a compounding cascade of increased costs.
And this specific dynamic inflation, driven by supply-side geopolitical constraints, rather than demand-side exuberance, places central banks like the U.S. Federal Reserve in a nearly impossible position.
You're listening to the Commodity Brief Podcast. If you're finding this valuable, make sure you subscribe wherever you get your podcast and check out our daily video analysis on YouTube at Commodity Brief. We publish new content every day covering the commodities market and alternative assets that matter most to investors. Now back to the show.
Walk us through that mechanical mismatch, because it's a crucial point in the commodity brief. How does the Fed usually fight inflation, and why does that weapon fail here?
Traditionally, if inflation is running too hot, it implies there's too much money chasing too few goods. Consumer demand is outpacing production.
So the central bank raises interest rates.
Right. By making it more expensive to borrow money, they intentionally cool down the economy. Mortgages get more expensive, retail spending drops, businesses delay expansion. This engineered destruction of demand brings prices back down.
But in the scenario we're discussing, the inflation isn't caused by a boom in consumer spending. It's caused by a drone striking a pipeline in the Middle East.
Exactly the problem. You can raise interest rates to 15%, you can crush domestic consumer demand into the ground, but raising the federal funds rate is not going to unblock the Strait of Hormuz.
Monetary policy cannot create more oil, and it cannot shoot down incoming munitions.
The central banks are completely trapped. If they hike rates aggressively, they risk triggering a severe domestic recession, all without actually solving the root cause of the inflation.
It creates this agonizing stagflationary environment. And this impossible situation completely upends how governments think about long-term energy strategy. The sources call this the new energy calculus.
Let's unpack that calculus, because it creates a fascinating, almost schizophrenic bifurcation in how capital is deployed over the next decade.
How so?
Well, the persistent instability in fossil fuel choke points suddenly provides the ultimate, unarguable mandate for a massive acceleration into renewable energy and nuclear power.
But for national security reasons now, not just environmental.
Precisely. Energy sovereignty. If a nation generates its baseline power from domestic solar grids, offshore wind, and nuclear reactors, it effectively immunizes its economy from the chaos of the Middle East.
A block strait halfway across the world cannot disrupt the wind blowing across the North Sea.
Exactly. Long-term capital is flooding into green energy and nuclear to secure the economic borders of the nation-state.
That makes perfect logical sense for a 30-year horizon. But there is a massive friction point here. The sources make it clear that you cannot build a gigawatt nuclear facility overnight.
No, it takes a decade, at minimum. But a nation cannot simply pause its economy for 10 years while it waits for the wind turbines to come online.
Which leads to the darker, contradictory side of the new energy calculus.
In the short run, to avoid immediate catastrophic energy shortages, governments are being forced to lean heavily on the most secure domestic energy sources they possess, regardless of the environmental cost.
Like coal, we are seeing a desperate resurgence in the utilization of domestic coal and heavily subsidized local natural gas.
It's the ultimate paradox. We're sprinting toward a clean energy future motivated by national security panic, while simultaneously burning more high-emission domestic coal right this second just to keep the hospitals running while we build the lifeboats.
It is a profoundly messy, volatile transition period.
And navigating this specific kind of intense volatility requires a completely new set of financial instruments. The legacy financial architecture is simply too slow, too rigid, and too localized.
This serves as the perfect pivot point into the second major theme of our discussion: redefining the speed of risk.
This is where things get really interesting financially.
Right, because think about the environment we just established. Supply chain instability is the daily operating reality. Geopolitical risk premiums spike on a weekend skirmish.
And if that is the world real-world businesses are operating in, the traditional financial tools we've relied on for a century, the ones that ring a bell and close their doors at 4:00 p.m. on a Friday, are suddenly dangerously inadequate.
They are relics of an analog era. The concept that global financial risk politely pauses for the weekend while asymmetrical warfare continues 24/7 is a structural vulnerability.
The gap between the speed of information and the speed of traditional price discovery has become a huge liability.
We need a new architecture. And this brings us back to the announcement from Kalshi regarding their dedicated commodities hub.
This isn't just a UI update. It represents a fundamental democratization of how global scarcity is managed.
Let's look at the historical context. If you wanted to hedge against commodity risk in the past, say you're a mid-sized regional airline worried about a spike in jet fuel costs, you were forced to navigate the traditional futures market.
And navigating that market is not for the faint of heart. Traditional futures contracts are highly complex, intensely capital-intensive instruments designed by and for massive financial institutions.
Let's try to visualize the friction involved there. Using a traditional futures contract to protect your mid-sized business feels a bit like that. Deciding you need to transport a single pallet of medical supplies across the ocean, but the only way to do it is to buy, staff, and maintain an entire Panamax cargo ship.
Oh, that's a great analogy.
Right. You have to hire the crew, do the maritime maintenance, pay the docking fees, manage the fuel. It's an overwhelming, continuous logistical nightmare just to ensure your one specific pallet gets from point A to point B safely.
In the financial world, that cargo ship represents the massive initial margin requirements, the complex daily margin calls, the headache of managing contract rollovers, the opaque fee structures.
The overhead of managing the instrument itself becomes a massive barrier to entry.
For a massive multinational, managing the cargo ship is just a cost of doing business. But for a regional airline or an independent manufacturing firm, it often means they simply choose not to hedge at all. They just absorb the risk and pray.
But what Kalshi is doing with the commodities hub is essentially dismantling that barrier through binary event contracts. Instead of buying the cargo ship, you just buy a simple direct ticket for the specific voyage you care about.
The value proposition is stripped down to its most elemental form. A binary contract simply poses a yes or no question. Will the spot price of crude oil exceed $85 a barrel by the end of this month?
It abstracts away all the institutional plumbing.
Exactly. When you enter a binary contract, your risk is absolutely capped at the price you pay for the contract. There are no surprise margin calls if the market moves against you overnight.
You know the maximum possible loss and payout the second you execute the trade. It takes a tool previously reserved for institutional treasuries and puts it in the hands of the corporate procurement manager.
Or the independent farmer. And we aren't just talking about legacy heavyweights like crude oil and gold anymore.
Right. The announcement details a massive expansion of covered assets. They are establishing active binary markets on natural gas, coffee, copper, sugar, corn, soybeans, wheat, nickel, diesel, and lithium.
What you're looking at is the complete financial mapping of the modern physical supply chain. They're taking every critical input required to sustain modern civilization and making the price risk tradable for anyone with an internet connection.
Now, crucial to this expansion, tying back to our point about the 4.0 p.m. Friday bell, is the 204/7 advantage.
This changes the entire dynamic of crisis management. When geopolitical conflict doesn't respect market hours, your ability to defend your balance sheet shouldn't either.
Let's imagine a scenario. It's 2.00 a.m. on a Sunday. News suddenly breaks via social media that a critical processing facility in the Middle East has suffered a catastrophic drone strike.
In the traditional financial system, if you run a logistics company highly exposed to diesel costs, you are completely helpless. You're forced to sit on your hands for 30 hours, agonizing over the news, completely unable to act until the institutional markets finally open on Monday morning.
You are literally a spectator to your own financial ruin.
Exactly. But on a platform like Kalshi, the price discovery mechanism never sleeps. That logistics manager can wake up at 3 in the morning, open their laptop, and immediately purchase binary contracts predicting a surge in diesel prices.
Effectively locking in a financial hedge that offsets the massive fuel bills they're going to face in the physical world on Monday.
It shifts the platform from being an interesting novelty to functioning as genuine, critical utility infrastructure.
But as transformative as 247 Access is, it isn't even the most radical development detailed in the sources. The true frontier of this new financial architecture, the concept that genuinely bent my mind when I read it, is the introduction of the 15-minute intraday contract.
It is the extreme expression of high-velocity risk pricing.
The platform allows users to take a position on where the price of a global commodity will be exactly 15 minutes from right now. And I have to pause here because I need to be the voice of the skeptical listener.
I know exactly where you're going with this.
Right. Because if you describe a system where people are betting on the micro movements of copper prices over a 15-minute window, it sounds indistinguishable from a casino.
It sounds like a digital slot machine disguised as high finance.
Exactly. How does a 15-minute contract function as a legitimate, stabilizing financial tool for the real economy, rather than just facilitating pure, unadulterated gambling?
It's a completely valid pushback. If a retail trader is sitting on their couch, blindly guessing whether silver will tick up or down in the next 900 seconds just for the thrill of it, then yes, it's pure speculation.
So where's the utility?
To understand the utility, we have to reframe our perspective. We have to look at it through the lens of a real-world business operator attempting to survive in an environment defined by instantaneous volatility shocks.
Okay, let's ground this. Walk me through a concrete scenario where a 15-minute contract actually saves a business.
Let's step away from energy and look at the agricultural sector. Imagine you manage the financial operations for a massive commercial farming conglomerate.
Okay, I'm the farm manager.
In the hyper-connected world, economic shocks don't take days to unfold. They're delivered via push notifications in milliseconds. Let's say you're monitoring the wire, and you know the USDA is scheduled to release an unexpected emergency crop yield report at exactly 2:00 p.m., addressing severe drought conditions in the Midwest.
An event that fundamentally alters the underlying value of my business the second the press release is published.
Exactly. The volatility spike is going to be violent and immediate. Historically, the farm manager just has to brace for impact and absorb the blow. You can't enter a complex 3-month traditional futures contract to protect yourself against an event that is going to fully price into the market in the next 10 minutes.
Traditional instruments are too blunt and too slow.
But with a 15-minute settlement window, that farm operator has a surgical tool. If they know the USDA report drops at 2:00 p.m. and their internal data suggests it'll reveal catastrophic yield drops that will spike the cost of replacement corn.
I can step into the Kalshi market at 1:5 p.m.?
Precisely. You buy a 15-minute contract predicting that the price of corn will surge between 2:00 p.m. and 2:15 p.m. You are applying a highly precise temporary financial shield exactly at the moment when volatility is guaranteed to peak.
And if the report is indeed catastrophic, the market panics, the price skyrockets, and that contract pays out significantly, which I use to offset the sudden cost of securing physical grain.
And if your internal models were wrong and the market remains flat, you lose the small defined premium you paid for the binary contract. You essentially paid an insurance deductible. But your underlying business remains stable.
It's a hyper-targeted, on-demand insurance policy. And what strikes me about this is how radically it reduces the long-term carry cost of hedging.
Oh, massively.
Because if you buy a traditional futures contract, you are essentially paying for blanket insurance 24/7 all year long, even when the market is totally quiet. The 15-minute contract means you're only paying for the armor during the exact 15-minute window when the financial artillery is actually falling.
It perfectly aligns the mechanics of risk management with the actual tempo of modern information distribution. We consume global news by the minute. It only makes sense that the financial architecture evolves to let us manage the economic fallout of that news by the minute.
It is the literal financialization of the news cycle. Now, we've spent the entire first half of this deep dive living in the fast lane. High-velocity crises, asymmetrical drone strikes, 15-minute algorithmic hedges. But as we pivot into the next phase of our analysis, we're going to radically shift gears.
We are slowing way down.
We're moving away from the loud, explosive world of global energy and entering a crisis that is completely silent, excruciatingly slow-moving, and arguably far more existential.
And yet, this slow-motion crisis is triggering the exact same scarcity signals across the global economy.
We need to talk about the global water bankruptcy.
It is the ultimate, undeniable physical scarcity.
If crude oil is the engine of the global macroeconomic machine, fresh water is the fundamental life support system of human civilization. And the financial markets are finally aggressively waking up to the fact that the system is blinking red.
Blinking red feels like an understatement when you look at the raw data.
It really does. The investment report from Green Wallet News delivers a historical metric that I honestly had to read 3 times just to make sure I wasn't misunderstanding the scale of the collapse.
It's a shocking number.
The report states that in 1947, global water availability per capita, meaning the total amount of renewable fresh water naturally available divided by the number of people on Earth, was 2,526 cubic meters per year.
Okay, 2,526.
Today, that number has plummeted to less than 600 cubic meters per person.
It is a demographic and ecological freefall.
To truly understand how dangerous that number is, you have to look at the United Nations established baselines for resource security. The UN defines the threshold for absolute water scarcity, the extreme danger zone where a society cannot meet its basic agricultural and hygienic needs, as 1,000 cubic meters per person.
And we're currently sitting at 600.
The analysts authoring the report explicitly describe this systemic deficit as a global water bankruptcy. Human demand is now systemically exceeding sustainable ecological supply across critical portions of the Earth.
And what is truly staggering from a financial perspective is how historical financial markets have completely mispriced or just entirely ignored this risk.
The complacency makes the banking sector's willful ignorance of the pre-2008 subprime housing market look cautious.
It really does.
I want to make sure the sheer scale of this drop from 2,526 to 600 actually resonates, because 600 cubic meters is an abstract number. Let's map this onto a commodity we're more familiar with.
Let's do the oil comparison.
Yeah, imagine a person born in 1947. Over the course of their single lifetime, imagine if the total global supply of extractable crude oil permanently shrank by 75%.
Think about the apocalyptic financial panic that would trigger. The resource wars, the collapse of national economies, the desperate restructuring of human society.
Freshwater has seen this exact percentage drop in availability per capita. It currently carries an annual, localized economic drought cost of over $307 billion globally. And yet, the broad financial markets are largely operating as if nothing has changed.
The blindness isn't necessarily malice, though. It is deeply structural. It stems from the fact that water is fundamentally a different physical and economic beast than any other commodity we trade on the open market.
The sources spend a lot of time on this distinction. Break down the mechanics for us. Why doesn't water behave like oil or copper or soybeans?
It comes down to three primary interlocking constraints. First, and most importantly, is basic physics. Water is incredibly heavy, and relative to its weight, it is exceptionally cheap by volume.
So the economics of transport are terrible.
Awful. If you pump crude oil in Saudi Arabia, you load it on a supertanker, ship it to Japan, and the profit margins work perfectly. The high value justifies the logistical cost. You cannot easily or profitably transport massive quantities of fresh water across oceans or continents.
It's highly localized. A surplus of glacial meltwater in Canada does nothing to alleviate a multi-year drought devastating the almond farms in Arizona.
Exactly. You can't just pipeline it across the Rockies economically. The second constraint is sociological and ethical. Water is internationally recognized as a fundamental human right.
Which introduces intense political dimensions.
Right. If a localized shortage causes oil to spike to $200, people drive less. But if a population cannot access or afford water, society rapidly collapses into mass migration and chaos. You cannot simply let the invisible hand of the free market ruthlessly dictate who gets to drink based on their purchasing power.
The political backlash would be instantaneous.
And the combination of those two factors, physical immobility and political necessity, leads to the third constraint. There is no single, unified, globally traded futures contract for water.
There is no global price signal for water scarcity.
Think about how copper works. A major labor strike shuts down a mine in Chile. The global spot price ticks up instantly in London and New York. That global signal directs institutional capital to build new mines in Africa or fund recycling startups.
But because water cannot be shipped globally, a drought in Spain doesn't change the price of water in California.
This siloing effect leads to a massive systemic mispricing of the risk on a macroeconomic level.
So if there is no global clearinghouse, how does this incredibly scarce resource actually get priced and allocated in the real world?
The Green Wallet News Report points out that the entire system rests on a patchwork of hyperlocal legal frameworks. They present a fascinating case study comparing two very distinct approaches to managing scarcity.
Let's start with the system that governs much of the American West.
The legal doctrine of prior appropriation,
Often summarized by the brutal shorthand. First in time, first in right.
it is a legal framework literally born in the dust of the 19th century Western gold rush. The foundational premise is that whoever legally claimed and diverted the water first holds the absolute senior right to that specific volume in perpetuity.
Which sounds vaguely fair in a romanticized frontier sort of way, but the report details how absolutely devastating this system becomes during a modern megadrought.
Because under strict prior appropriation, if a river basin is suffering a historic drought and there isn't enough water to satisfy every legal claim, there is no concept of shared sacrifice.
No proportional reduction at all.
None. The system dictates that the senior rights holders, even if they are utilizing inefficient flood irrigation to grow highly water-intensive, low-margin crops like alfalfa for cattle feed, are legally entitled to receive 100% of their historical water allocation.
Meanwhile, the junior rights holders, which could be a booming modern metropolis or a cutting-edge semiconductor plant vital to the national economy, simply get cut off. They get zero.
It is a wildly rigid binary legal mechanism, entirely blind to modern economic efficiency. It operates solely on the date stamped on a century-old piece of paper.
Now contrast that archaic system with the second framework the report holds up as a modern alternative, Australia's Murray-Darling Basin.
The Australian model was forged in the fires of an existential crisis. In the early 2000s, Australia suffered the Millennium Drought, a multi-year event that pushed their agricultural sector to the brink of collapse. It forced them to completely rethink their relationship with water.
And what did they do differently?
They instituted a revolutionary legal shift. They formally separated the legal ownership of the physical land from the legal ownership of the water rights.
Crucial decoupling. You can buy the water entitlement without having to purchase the farm.
Precisely. And, equally importantly, before a single drop is allocated to human use, the system establishes strict environmental baselines. The river system itself is recognized as having a senior right to a certain volume just to survive as a functioning ecosystem.
And once that baseline is met, what happens to the rest?
The remaining available water for that specific season is converted into defined allocations, which can be freely and transparently traded on an open, regulated market.
Let's look at how that actually changes human behavior during a drought. If I'm a farmer growing a very thirsty, low-margin crop, let's say cotton, my calculus completely changes.
Because you can look at the transparent market price of water on the exchange.
Exactly. I'm going to look at the screen and realize, you know what? The open market is pricing water so highly right now that my water allocation is actually worth more as a raw, tradable asset to a high-value almond grower down the road than it is if I pour it onto my own cotton field.
So you make the rational economic decision to fallow your field for the season, sell your water allocation, make a guaranteed profit without planting a single seed.
And the scarce water automatically flows to the agricultural sector where it generates the highest economic value per drop.
It is an incredibly elegant solution that reveals a genuine market price for scarcity, and it creates a massive financial incentive for conservation. If a farmer invests in drip irrigation, the water they save is a financial asset that can be quantified and sold.
This brings us to a critical juncture for the listener. We've established this massive global mispricing of a resource that is rapidly disappearing, which brings us to investing in the hidden market.
If you've accepted the premise that water is the ultimate scarcity signal, the obvious question is, how does the market actually interact with this?
Right, because you can't just go into your brokerage app and buy a barrel of water.
The report outlines a highly specific investment thesis for water rights, resting on three foundational pillars that drive the long-term appreciation of these unique assets.
Let's break those down. Pillar number one.
Pillar number one is structural scarcity, the brutal math of climate change and hydrology. Snowpacks are shrinking, evaporation rates are increasing, deep underground aquifers are being rapidly depleted.
The physical, volumetric supply of available fresh water is objectively shrinking year over year. Shrinking supply equals rising value.
The second pillar focuses on the demand side, inelastic demand. This is crucial for understanding why water assets behave differently.
Because farms and municipalities cannot substitute another liquid for water.
Exactly. If the price of beef skyrockets, consumers substitute with chicken. But you cannot irrigate 1,000 acres of wheat with anything else. A city cannot flush its toilets with anything else. The demand remains rigidly fixed regardless of how high the price spikes.
And the combination of structural scarcity and inelastic demand leads to the third pillar, regulatory protection.
In established markets like Australia, a water right isn't a loose regulatory suggestion. It is a legally protected, deeply entrenched property right. For institutional investors looking for a haven, these are defensible assets offering genuine non-correlated returns.
But the report is very careful to balance this thesis. Treating water as a pure financial asset is incredibly fraught. It carries unique risks.
The primary risk is political. Because water is essential for human survival, governments will always retain the ultimate trump card. If a severe drought pushes a major city to the brink of running dry, a sovereign government will absolutely change the allocation rules overnight.
They'll override historical property rights to ensure the population survives.
Exactly. Your legally protected property rights suddenly becomes a secondary concern to national stability. And beyond that, the report highlights the profound complexity of indigenous water rights claims.
Right, in the U.S., Australia, South America, indigenous communities are asserting historical, pre-existing rights to water resources.
Which legally supersedes modern colonial-era frameworks. It introduces a layer of deep historical and ethical complexity. You can't just buy a water entitlement and assume your title is clear. The underlying ownership is often subject to ongoing legal adjudication.
So, directly buying physical water rights is complex and carries unpredictable risks. It's totally out of reach for the average retail investor. So what are the accessible avenues?
The old adage applies. If you can't buy the gold, you buy the kicks and shovels, you buy the pipes, the pumps, and the technology.
Public equities focused on water infrastructure.
Yes, massive publicly traded companies like Xylem and Ecolab, as well as broader water-focused ETFs, the utilities that manage the flow, the engineering firms designing desalination plants, the technology providers building smart meters.
As the raw resource gets scarcer, the tech to aggressively recycle it and prevent leaks becomes exponentially more valuable.
And the commodity brief also points toward the hidden market of water scarcity. It's about analyzing how ordinary massive corporations are silently pricing in their own operational water risk.
Like municipal bond markets, funding wastewater recycling plants.
Or beverage companies aggressively spending capital to lock in long-term water supply contracts. They are building physical resilience directly into their balance sheets.
The hidden market is just the mandatory integration of water scarcity into standard corporate valuation models. But what about modernizing the local markets that do exist? This brings us to the tokenization of water rights.
This is truly where the ancient physical world violently collides with digital finance.
The reality of a water deed right now is almost comically archaic. Your legal right to access water is literally a dusty, century-old piece of paper in a courthouse basement.
It's incredibly slow and highly opaque.
What tokenization proposes is converting that dusty paper deed into programmable digital code that lives on a secure blockchain.
You are turning a static legal document into a dynamic, tradable asset.
And it can interact with the physical world. Tokenized rights can be directly linked to IoT smart meters installed on the physical pumps.
Solving the Oracle problem. The smart meter physically verifies the water was not pumped. The smart contract recognizes the conservation and instantly sells the surplus on a digital marketplace.
It solves severe illiquidity and massive transaction friction. You provide instant, verifiable proof of ownership, completely eliminating the risk of double counting.
A farmer can sell a tiny fraction of saved water to an industrial user seamlessly, in seconds.
Now, this technology is still in the pilot stage, but the long-term potential is massive. But we have to end this segment on the most sobering point the report makes, acting as a reality check.
Because we can build the most elegant blockchains and 15-minute predictive markets, but the ultimate foundational hedge against water scarcity isn't financial.
It is purely ecological.
The nature-water nexus. The physical infrastructure of the Earth dictates the financial reality. Wetland destruction entirely eliminates natural water filtration. Deforestation destroys the steady base flow of rivers.
You could own the most perfectly tokenized water right in the world, stored in your digital wallet, but it is completely worthless if the upstream forest has been clear-cut and the physical river simply runs dry. The blockchain cannot summon water from dust.
Exactly. The digital representation requires the physical reality to exist. Investments in wetland restoration and regenerative agriculture are hard, unavoidable financial dependencies required to protect downstream economic assets. Nature is the core infrastructure.
Which brings us to our outro. We've covered a staggering amount of ground today. The Strait of Hormuz, global aquifers running dry, Kalshi's democratized 15-minute binary bets, and blockchain tokenization of water deeds.
It's a lot to synthesize.
So addressing the listener directly, in a world where these scarcity signals are moving faster than legacy markets can possibly price them, what should you actually be doing?
A very clear three-part strategy emerges. First, fundamentally broaden your definition of a leading economic indicator.
Stop obsessing exclusively over Fed interest rate decisions.
Exactly. Start aggressively monitoring physical scarcity signals. Local water right allocations, severe drought forecasts, geopolitical risk premiums on maritime choke points. These physical constraints are the true early warning systems for systemic inflation.
Second, actively explore and familiarize yourself with new, accessible risk management hubs like Kalshi.
The democratization of these tools means everyday investors and small business owners can utilize binary event contracts to manage directional risk cleanly and in real time, 247.
And finally, the structural approach, the barbell strategy.
Load your exposure at the two extreme ends of the spectrum. On one end, prioritize hyperagility. Use micro-duration tools like 15-minute contracts to surgically shield yourself from sudden headline shocks.
And on the other, massive end of the barbell, anchor your portfolio with deep, long-dated structural resilience.
Deploy capital into essential water infrastructure, desalination tech, and natural capital restoration projects guaranteed to retain value as the physical limits of the Earth become apparent.
Hyperagility to survive the daily news cycle, and deep structural roots to survive the decade. I love that framework. Well, to wrap up this deep dive, I want to leave you with a final, slightly provocative thought to mull over.
Lay it on us.
We spent the last hour marveling at the most advanced, high-velocity financial tools ever created. 15-minute binary digital contracts, programmable assets on blockchains, AI-driven prediction markets.
The absolute pinnacle of our digital capabilities.
Yet when you strip away the complex math, what are we actually using all these futuristic tools to manage?
We are using them to manage the mud, the rock, and the water.
Exactly. We're using the bleeding edge of the virtual world to desperately manage the most ancient, elemental, physical constraints of the Earth. We build complex algorithms to calculate the odds of steel ships passing through a narrow, rocky strait of saltwater. We deploy blockchains to trade the basic physical necessity of rainfall falling on dry dirt.
As our technology becomes increasingly infinite, its primary purpose is managing a physical world that is undeniably finite.
It is a profound paradox to think about the next time you turn on the tap or check the price of gas or watch a headline flash across your screen. Thank you for taking the deep dive with us today.
That's it for today's episode of the Commodity Briefs podcast. If you enjoyed this, please leave a review on Apple Podcasts or Spotify. It really helps. Subscribe for weekly episodes and visit commoditybrief.com for daily articles and analysis. See you next week.